Today, really going to start to get into some of the detail, particularly how to value a business, how to financially vet it, how to structure a deal, and then how to finance whatever capital needs to go in so that you can close it and own it. So there's going to be some numbers, right? Numbers are not going to kill you. I love numbers, and numbers love me. Okay, right, so you're not going to die, okay? But before we go into this, I get it, some people are just not into numbers, right? Some people are not. Some people are into operations or they're incredible at marketing or sales or building relationships. Some people are not numbers, right? So if you're absolutely great at numbers, just stand up for me. If you're really good at numbers, stand up. Okay, right? So if you're sat down and you're not good at numbers, go and talk to one of the people that sat up. That could be one of your next deal partners, right? If you're really good at operations or marketing or sales or creating rapport, but you're not good at numbers, just go and connect with somebody that is just the nearest person to you. Blink them, get their details, because if you don't like what I'm going to show you today about numbers, you can partner with somebody or get some help from somebody that does it, right? So just bear that in mind. Now, we're going to kick this off about valuation. So there's three things I'm going to teach you today. I'm going to teach you how to value a business. I'm going to teach you how to structure a deal. And then I'm going to teach you how to finance a deal if it needs a closing payment, right? Now, valuation actually has four components. Like if you go talk to a business broker or even a lot of CPAs, they only ever look at financial valuation. They don't look at how seller psychology can change the valuation of a business. Remember yesterday, we had those two sellers. One's highly motivated to sell, could be sick, could be dying. Do you think that person really cares about the financial valuation when they want to get out of the business versus the seller that's just not motivated at all to sell, but will sell for the right price? So it doesn't matter what the numbers are. The seller psychology is really, really important. So you have to understand that and how that drives your valuation. You also need to understand how a deal structure can change the valuation. If you're buying a business and you're putting 90 or 100% of the cash down at closing, you're going to be paying less for the business versus if you were buying it over a 10-year seller financing note, right? If you're putting all the money down at closing, you or the bank is taking the risk, right? The seller's taking no risk. So that will reflect a lower valuation. If the seller is taking all the risk because they're going to get paid over 10 years, we're going to talk about that this afternoon. That's called the annuity deal structure. But if the seller's taking all the risk, they're going to want more money for the business. So you have to understand how the deal structure impacts valuation. And then the fourth part, nobody in the world talks about this, right? And I teach proteges this in a lot of detail. I'm going to go over it a little bit today. Nobody talks about the transfer of value. It doesn't matter what the financial valuation is. If you can't monetize that value as a new owner, the business isn't worth anything, right? So I'm going to show you how you can vet a deal and understand what is called goodwill. So every business has something called goodwill. I'm going to explain what it is. I'm going to show you how to value it. I'm going to show you how to look for it in the deals that you're doing. So let's start off with multiples. So most businesses in the world, especially in the 1 to 10 million range that you guys are going to be going after, they're valued at a multiple of profit, okay? Now, the profit measure that we use, and I'm going to go through this in a lot of detail in a minute, is called EBITDA. Stands for earnings before interest, tax, depreciation, and amortization of goodwill. It's basically the operating profit or the operating cash flow that the business is throwing on every single year. Now, there are two things that drive that multiple. Number one is the size of the profit, right? So the bigger the profit, the bigger the multiple. That's why a company like Apple trades for 24.4 times its EBITDA. It's a $1 trillion business. It's got massive C-suite, incredible systems and processes. So the bigger the business, the bigger the multiple. What also drives the multiple up is how sophisticated the business is. And we're going to get into that when we talk about transfer of value. But if you've got a business that's super high niche, high growth, high margin, it's a massively optimized business, it's a best-in-class type of operation, it's got lots of IP or barriers to entry, and you've got a seller that's not really motivated, that's going to drive the multiple up. On the contrary, if you've got a business that's commoditized or generalized, it's not really growing, the margins are pretty bad, it lacks a lot of optimization, and anybody could get into that industry, that's going to drive the multiple down, as will the motivation of the seller. So on average, this year, the average multiple of all small businesses under 10 million that were sold in the United States, about a couple of 100,000 deals so far this year, is around 3.3x. So what you're going to be doing today is a lot of mental math, right? So generally, when you look at profit, you want to be multiplying it by 3 in your head, and that's roughly what the valuation is going to be, subject to all the things that I'm going to teach you today. Now, when you're looking at deals, there is a resource. It's called DealStats, right? So DealStats track all of the multiples of all of the deals in all of the sectors in this country. And if you're in Protégé, which I know some of you are, you have access to this, right? So when you're looking at a deal, you know what the average multiples are for that particular type of business, per its size and per the industry. And what you'll notice since, I'm guessing 2018, and kind of COVID had a bit of an impact on this, is multiples have gone down massively. They went down from around a 5x average in 2018 down to less than 3, and then it started to kind of pick back up again, right? And then, but that's across all industries. And some industries have higher multiples than others. So like IT, technology businesses, SaaS companies, financial services, healthcare, they tend to be higher multiples. But more general businesses like construction, manufacturing, home services, even a lot of professional services businesses, they tend to have lower multiples. But what we're really interested in when we're looking at this data is those smaller deals. It's those 1 to 5 to maybe $10 million revenue businesses. So across all of the industries, the average last year, or this year as well, was about 3.3 times. So if you look at profit, if you look at a business that's got $330,000 in EBITDA, and I'll share how to calculate that in a minute, then your mental math, you know that's $1 million deal. It's going to cost you $1 million to buy that business. And then what you can do, there we go. What you can do with DealStats is you can actually look at what the multiples are in each particular industry. Can you turn the screens back on, please? So you probably can't see the slide right now, or you will in a minute, but some sectors are really high, like technology. So technology this year was around 7x, and a lot more traditional industries like retail or construction, manufacturing, were kind of more in the 2.5 range. So what you can also do with DealStats as well, and this is really important, is it will tell you from all the businesses that have sold what their profit margins are. So when you're looking at your own deals, you can kind of benchmark those deals around what the average profit multiples are in the industry. And if you go across the whole of the industry, all of the deals that were sold, this is in 2022, the average profit margin was between 10%, which is quite low, up to 38%, which is actually really, really high. You won't find many deals that have 38% operating profit margins. So let's do some math, right? So some of you will know this inside out, back to front, right? But some of you might not have looked at company financials ever before. So I'm going to go through this really, really quickly, and we're going to stack, and I'm going to make sure at every stage that you all understand this. So let's imagine you're looking at a deal, and it's doing $2 million in revenue. So those are the sales receipts the business is taking in from its customers. Now, every business has something called COGS, or cost of goods sold. So if they're selling a product, what is it costing them to manufacture that product before they sell it to the customer? Or if it's a professional services business, what's the cost of the people that are delivering that service? So you take revenue, less cost of goods sold, and that equals something called gross profit. And then you divide the gross profit by the revenue, and that's the gross profit margin. Okay, everybody understand that? If you don't, you're fucked. Right? Okay, you get it, right? Okay. And then, so beyond, just kidding, beyond that, every business has overhead, sometimes called SG&A, sales, general, and admin. So it's the cost of running the business. It could be the premises, it could be the admin staff, it's the cost of the management team, it's travel, it's benefits, it's expenses, it's kind of all that stuff, right? So let's say in this example, the business has got $750,000 of total overhead. So you deduct that from the gross profit, that gives you something called EBIT, earnings before interest and tax. In this example, $250,000. But then what we do is we add back the D and the A. The D is depreciation. So in accounting, when you buy an asset into your business, you spend cash, it sits on your balance sheet, and then the IRS lets you depreciate that over a number of years. But that's a non-cash item through your income statement, right? So you get to add it back to calculate what the true cash flow is. And then amortization is exactly the same, but it's depreciating like an intangible asset, like intellectual property, goodwill, things like that. So you always add back the depreciation and the amortization. And a lot of accounts that you'll get from business owners or from brokers, if you go down the broker route, they'll actually calculate what the EBITDA is for you, but you can look on the tax return, takes 3 seconds, and you can add it back. So in this example, the EBITDA number, and this is the uniform measure of operating profit you are always going to use in deals. I'll explain what that is in a minute. So you take your EBITDA, in this example, $300,000, you divide that into the revenue, it's 2 million, and that gives you the profit margin, 15%. So remember from the last slide, the average was 10 all the way up to 38, depending on the industry. This example, this is a marketing agency, by the way. This example, it's a 15% margin, okay? Now, once you've done that, everybody understand that? Right, now we're going to start stacking. It's going to get a bit more sophisticated. So there's 4 things we now do to play with that number. The first thing we do is we look at something called SDE. If you go on a business broker site, especially in America, not in the UK, but in America, brokers have invented this word. It's called seller's discretionary earnings, right? I'm going to explain to you in a minute how to go from EBITDA to SDE and vice versa. It's really, really easy. Then we're going to talk about add backs, or what I call recasting of EBITDA. And what add backs are is we look at the business today with the owner inside of it, with his yacht and his vacations and all of his family members and his dogs and all of those things. And then what we do is we add back a lot of those non-operational expenses to recast what's the profit going to be when I own the business, right? Not when the owner owns the business. Sometimes the profit can go up, sometimes the profit can go down. So we have to make that adjustment. So we'll do that. The third thing we do is we calculate 2 numbers. One's called EV, which stands for enterprise value. What does that mean? It means what's the value of the trading business, and then equity value is what's the value of the stock. And the best way to kind of characterize that is, let's say Crystal owns $1 million home. That's her enterprise value, but she's got a $500,000 mortgage on that house. So her equity value is $500,000, right? It's the $1 million value of the house less the mortgage. It's the same with the business. So we have to adjust the enterprise value to allocate for debt, for real estate, if that's going to be part of the deal, and things like surplus cash. So we're going to go through that. And then we need to look at something called working capital. So working capital in a business is like fuel in a car. If you go and buy a car, and this has happened to me, by the way, I bought a Porsche Cayenne SUV, I got in the car, there's no fucking petrol in it, right? I'd just blown $150,000 at a car, there's no petrol in it, it wouldn't drive. They'd not put any fuel in it. And businesses are the same. If you buy a business that's got no working capital, you can't trade it, right? It's exactly the same as fuel in a car. So we make sure that when we buy a business, it's got enough working capital inside of it for you to operate it successfully. So let's go through each one. So SDE, seller's discretionary earnings, is basically the EBITDA of the business plus all the money that the seller is taking out of the business, but that does not include distributions. So it's income, consulting fees, benefits, expenses, all of that stuff. So you add all that together, EBITDA plus all the money that the owner takes out of the business, not including distributions, that is SDE. So when you go onto a broker site and they'll say, yeah, this deal's got $500,000 of SDE, but the owner's taking $200,000 out, it tells you that the EBITDA is $300,000. So you need to know the difference between the two. Some broker sites will talk about SDE, some broker sites will talk about EBITDA. Now you know the difference between the two. Everybody tracking that? Really important. Next, let's look at recasting of EBITDA. So we had the $300,000 of EBITDA. We've added back the owner's benefits, all the money that the owner's taken out in expenses and benefits and salary and fees and all those different things. And then there might be other add backs, right? So sometimes in a business, and I do this, your family members might be on the payroll, but they don't work in the business. So when the owner sells the business to you, those family members, the cost of those family members is going to disappear. So that is an add back, right? Another example of an add back would be, let's say the owner is paying $1 million a year into their 401k, right? They're not going to be paying that $1 million a year into their 401k when they sell the business to you. So if that's going through the income statement, that is an add back, right? So you add that back. And then you have something called take backs. So add backs increase the profitability, take backs reduce the profitability. A good example of a take back would be if you're buying the business, whether either you're going to operate that business, so you need to earn a salary, or you're going to hire a general manager or an operating partner that's going to come in and they're going to earn a salary. So a take back would be the market cost of that replacement. Another example of a take back would be, let's say you're buying a company and it sits inside of its own real estate, but for whatever reason, you don't want to buy the real estate, you only want to buy the business, and you're going to rent the real estate from the owner. So you need to adjust the profitability by that rental cost that now you're going to incur as the owner of that business. So remember, in all this recasting, all you're looking to do is say, this is what the profitability is today. When I take that owner out of that business, and I'm now the owner, what is the profit going to look like? Forget growth and all the efficiency and all the improvements you're going to make. At its current state of affairs, what is that number going to look like? So that's called recasting. Sometimes you add back to profit, sometimes you take back to profit. Is everybody tracking that? Yeah, perfect. So then what you do is we take averages. So we take 3 years averages when we're looking at profits, right? Because if the profitability is going up, I'm not paying on a multiple of the current profit. That could be a banner year. That could be like a great year. Sometimes you look at broker deals, smells like a broker deal, and they groom the business for sale. They go absolutely balls deep for 1 year to really juice up the numbers, and then they try and sell it on a multiple of that number. No, we take a 3-year average. So in this example, revenues went up $1.5 million, $1.8 million, $2 million. The adjusted EBITDAs, we've done those calculations, went up from $290 to $325 to $450,000. So I'm only buying that business on a multiple of that 3-year average. So in an uptrend, you take the average, but not in a downtrend. In a downtrend, I'm only taking the lowest number, right? But word of warning, if If you look at a business and it's trending down, that should be a red flag for you. And one of the first questions you need to ask in a seller conversation is, what the fuck is going on? Why is this business declining, right? And even if you understand why it's declining, the question you've got to ask yourself is, do I have the skills, or does my team have the skills to turn it around, right? Is this a plane that's going to crash into the sea? Can I rescue it, right? If you can't, then don't buy the business, right? Those deals, by the way, will be super cheap to buy and super creative to structure, but no point even doing that unless you know why it's crashing and how to turn it around, okay? So we take an average, or we take the low number in a downtrend. So let's do it. So we've got 355 of adjusted EBITDA. Let's take a 3 times multiple for now. So that's an enterprise value of $1,065,000. So that's the value of the business, or in Crystal's case, that's the value of their house, right? Now what we're going to do is we're going to adjust it to calculate equity value. So there's 3 things we adjust for. Number 1, real estate. So if you're buying a business that's got real estate, you're paying for the business and you're paying for the real estate. You don't have to buy both. You typically would, but you can just buy the business. Let's say you see a hotel, right? And the owner doesn't want to sell the actual real estate, but wants to sell the trading, cash flowing business inside of it. You can just buy that and then rent the real estate from the owner. If you're buying real estate, that gets added. What we then do is we're looking at that fuel, right? And some businesses that you look at have surplus cash. So every business really needs to have at least a month's worth of sales revenue as cash in the business. Some businesses you might need a bit more, some businesses a bit less, but on average, you're looking for 1 month's worth of revenue as physical cash in the business. So you take the annual revenue of the business, which in this case was 2 million, and you divide it by 12, okay? That would equal $167,000. But this business has got $302,000 in the bank at the time that you're vetting the deal. So the difference, which is $135,000, that is surplus cash. That belongs to the business owner, right? Retained profit that they haven't yet took out in distributions. When you're looking at LLCs and S-Corps, which typically have a flow-through tax model, I won't bore you with that today, you find businesses with not a lot of cash inside of them. If you're buying a C Corp, which would be a larger, more complicated business, they're double taxed, so the cash tends to stay inside of the business. So if there's more than 1 month's revenue in cash in the business, you've got to add that to the purchase price, but you can use it in financing. I've done so many deals where I've used surplus cash to finance the closing payment. It's absolutely amazing. We're going to go through that in a minute. So let's do the math on this. $1,065,000 was the enterprise value. We had the surplus cash. And then the third thing we adjust for is the debt that's inside of the business. So let's say as part of the deal, you're going to inherit a couple of $100,000 of liabilities. It could be payroll tax, it could be a bank loan, it could be money to the IRS, it could be lease costs on equipment, whatever it is, right? So we're going to take that off. So we add all that up. This business is now worth $1 million. That's the equity value of the business, right? So let's look at the balance sheet. So a balance sheet, so let's go back to an income statement for a second. An income statement is the financial performance of a business over a period of time. You can have income statements for 1 month, you can have income statements for 1 quarter, or you can have income statements typically for 1 year, right? A balance sheet is a snapshot in time. It's what is the financial picture of the business right now. So I could log into any of the businesses I own right now, and I could print off a balance sheet, and it would tell me what my asset and liabilities are at 9:50 a.m. on Saturday, the 11th of November, right? We can do that. And on a balance sheet follows what we call the accounting equation, which is the total assets in the business less the total liabilities that are in the business equals what we call owner's equity. Sometimes you might refer that as shareholders' funds. Sometimes it's called net asset value or net book value, but it's always the same. So what are my assets less what are my liabilities equals, what is the book value of the business? What is the owner's equity? And your assets in your business and on your balance sheet are things that the business owns, okay? You can have fixed assets like real estate, like desks, like trucks, like machinery, even intellectual property, and you could have current assets. Current assets form part of your working capital. So cash is a current asset. Accounts receivable is a current asset. Inventory is a current asset. A current asset is something that gets turned into cash within a 12-month period. So that's assets. Liabilities are things that the business owes. They owe money to other people, right? Could be current liabilities like AP, taxes due, payments due on a bank loan this year, payments due on hire purchase equipment this year. And then you have something called non-current liabilities, which are liabilities, money that you owe after that 12-month period. So if you go and get a piece of equipment and you finance it over 5 years, the first year of that is a current liability. The last 4 years of that are a non-current or long-term liability. So working capital is basically your current assets less your current liabilities. And where we take 1 month's worth of revenue for cash, we want 2 months worth of revenue for working capital. So in this example, our current assets are 500,000, our current liabilities are 150,000. So our net working capital is 350. And then the minimum that we want is that 2 million divided by 6, which is 2 months worth of revenue, which will be 334. So there's enough working capital in this business. I'm kind of happy with that. Okay, so, and then you don't really need to kind of get into this amount of detail, but just to complete the picture on the income statement, this is how you take EBITDA right the way down to like retained earnings. So 335 was the adjusted EBITDA average, less interest, which is I, less depreciation, which is D, less amortization, which is A. That gives you your pre-tax profit, commonly referred to as net operating income, NOI. Then you pay tax to Uncle Joe Biden, and then what's left is your retained earnings. If this was an S-Corp or an LLC, the pre-tax money flows through to the owners, and then they pay tax through their personal tax return. So this is what it would look like for C-Corp. Now, this is the fun part. Liquidation value, right? So we've just done an analysis of a business and calculated its value with all those numbers. But 62% of baby boomers that try to sell their business fail, and they end up just liquidating it. So what is a really interesting data point for you guys as part of your negotiation is, what would that liquidation value number be? Because you could argue then, well, that's the starting point of my negotiation to buy the business, because that's all the seller's going to get if nobody buys it, and they have to close the doors and turn off the lights. And most business owners don't want to do that because it kills their legacy. It hurts their employees because they lose their jobs. It lets their customers down, right? It lets their suppliers down. In some cases, it actually costs them money to shut a business down. So why wouldn't they sell it to somebody like you in a creative way? And our rule of thumb for calculating liquidation value is we take 80% of what that net asset value of the balance sheet is, right? So in this example, the balance sheet value was only $500,000. 80% of that is $400,000. So if this was my business and I couldn't find anybody to buy it from me, my only option is to liquidate it. I'm only going to get about $400,000. I'm going to get about 80% of my assets as I turn them into cash, and then I'm going to be able to negotiate down to 80% of my liabilities. So I'm going to get about $400,000. So that's my liquidation value. So you need to know that, right? Now, the difference between the first calculation, which is $1 million, and the liquidation value, which is $400,000, is called goodwill. Now, what goodwill is is the business's ability to continue to trade and generate revenue and cash flow for its owners, right? Some businesses, the goodwill is very, very high. Some businesses, the goodwill is very, very low. So in this example, we had $1 million of valuation using that first analysis. We know the liquidation value is $400,000. 600K is goodwill. So let's say this is my business and I've priced it at $1 million. That's my asking price. But you're looking at my balance sheet and saying, well, okay, this guy's got $500,000 on his balance sheet. He's going to get 8% of that if he liquidates. So really, his liquidation value is $400,000. That's what he's going to get if he has to shut the business down, but he's asking for $1 million. And then that's your negotiation stack in between. And that $600,000 gap is called goodwill. Now, your goodwill in any business has 4 key components. The first one is the quality and the sophistication of your customers. So, for example, if you've got a business that's got 1,000 customers versus you've got a business that's got only 1 customer, which is the better business to buy? 1,000 or 1? 1,000, right? Because if one of those customers lets you down, it doesn't matter. That 1 customer lets you down, you're fucked, right? So you would never, ever, ever buy a business that only got 1 customer, right? It's got no transfer of value. Monthly recurring revenue is a really good piece of customer goodwill. If you've got customers that are paying you each and every month and they're on these big long-term contracts, that's a very positive driver of goodwill. Versus if you're a project-based business and you have to go out and win that job and then pay for that job, that's not so good, right? Employees. If you've got employees with long tenure, they're qualified, they're trained, there's great morale and culture in the business, that drives goodwill. Versus if you've got a business that's got a very high turnover of employees, or you've got a business where it's very, very hard to get new employees in to grow, that would erode goodwill. Structural goodwill is the systems, the processes, and the KPIs in the business. One of the biggest challenges for business owners today in this country is they are the business. A lot of these really small deals, remember I talked yesterday, like don't ever buy a business really below $500,000 in revenue, because the owner is the operator, is the business. All the customer relationships they control, all the systems and processes are in their heads, nothing's documented. So if you buy that business and they fuck off, you're done, right? The business will fail, right? So that would kill goodwill. And then you've got social goodwill. Social goodwill is what's the external brand and reputation of the business in the market? Is this a business that everybody loves, like Apple, or is this a business that everybody hates, like Target, for example, right? So what's the social capital? I don't know what the problem is with Target. Chris has never told me. I love Target. I go in there every day in Florida. It's amazing. It's like, no, you shouldn't go there. Why? It's cheap. I love it. But yeah, some businesses have like really strong social capital. Some businesses have very weak social capital. So that's going to drive that kind of valuation. So those 4 pillars of goodwill are either going to drive value and make it a best-in-class business, or they're going to kill value. And they're going to make it, in some cases, an average deal, or a deal where you're only ever going to really be able to offer liquidation value for it. So that's the business that we looked at in the example, right? $2 million of revenues, $355,000 in EBITDA, right? So business A scored a 2 out of 5, and you can do this when you go and have a seller meeting, right? You can ask all these questions. So let's say business A, in your conversations, you don't like the customer base. It's concentrated, it's not recurring, it's a bit choppy, long sales cycle, all those different things. So you might score business A a 2 out of 6. Business B, much better customer base. You might score that a 4 out of 6. Employees, they're kind of average in business A, 3 out of 6, but they're solid, they're really strong in business B, a 5 out of 6. Structural capital, business A's got little to no KPI systems and processes, versus business B has got really strong KPI systems and processes, so that would have a higher score. And then business A has not got a great reputation in the market, but business B is a lot stronger. So, and you can do that. You don't have to be super sophisticated with it. It's just to give you a sense and a steer of what the transfer of value might look like. So business A scores 37.5% on the transfer scale. Business B scores 75%. So who thinks business A is the better business? The valuation's the same, right? Remember I said at the start, you can't just look at the numbers. You've got to vet these deals and see how sophisticated they are. So who thinks business A is the better business to buy? Nobody, right? It's business B. Business B has got higher transfer of value. But if you only look at the numbers, you're going to come up with the same valuation, right? So you have to understand what drives value or kills value in businesses that you're looking at. And you can actually calculate the value distribution on this stuff, right? So if those are all the deals that ever get sold, most deals are in that kind of average point. So if they score between 45 and 72% in that transfer value scale, we class them as an average business. If they score more than 72%, this is a really good business. This is a very, very good business. So you're going to pay a premium on the multiple for that type of business. If that business scored a 6 in every single category, you might be paying double, triple, or quadruple what the standard multiples are. Can anybody tell me why that is? If you've got the absolute best business in the world in a particular industry that's killing it on every single sector, it's crushing it, why would that business sell for a massive premium? Yes? That's true, but that's not the main reason. No? Everybody wants it. Thank you. So everybody wants it, right? Do you remember when the PS5 came out? Me and my son Josh were gamers, right? When the PS5 came out, he said, Dad, really want one of these PS5s. They're like totally badass. Talks like an American like me. Totally badass. We've got to get a PS5. You couldn't buy them for love nor money. We have a saying in the UK, they were as rare as rocking horse shit. Have you ever heard that? Rocking horse shit. We say that in the UK. They were as rare as rocking horse shit. And I remember the Buzz Lightyears back in the day. Sometimes the supply is too low for the demand, right? It's the same when you're buying a business. If the demand for that business is super high, but the supply is really low, people are going to bid that price up. We paid $1,700 for our PS5 because we really wanted it, right? We desperately wanted to get it, and we were prepared to outbid every other idiot that was doing it. And it's the same with business deals. So best-in-class deals will command much higher multiples. Kind of want to stay away from those deals, right? Those deals are really hard to fund and really hard to structure. The best deals are really kind of in the middle. There's average deals. Now, when you've got a business that scores below 45% on that transfer value scale, it's only worth its liquidation value. Its goodwill is effectively zero. Now, I'm not saying you can't do those deals, because you might have the skills or your team might have the skills to improve that business and make it a lot more profitable. And just remember, if you buy a business and you can move it in this direction, isn't it? Went the wrong way. If you can move it in that direction, you're building shareholder value by making it a more sophisticated business. What's that got to do with the financials? Nothing, right? But brokers, they don't understand this stuff. They just don't. This is why oftentimes they'll overvalue a deal because they're not considering all these other factors. Okay, so that's transfer of value. Let's talk about seller psychology. I touched on this yesterday. Two businesses, absolutely identical. Let's say it was the business we just looked at, right? It's the same business, completely the same business. Nothing's different apart from the owner and the owner's seller psychology or their motivation. In Protégé, we call it the MUD score. How motivated are they to do a deal? What's the urgency of closing that deal? and what's their level of distress, AKA, why do they want to sell, right? If you've got a business with a seller with a very high MUD score, not only are you going to be able to buy it for a much lower multiple, you're going to be able to structure the deal where you can pay most, if not all, of the cash in the future. That's got nothing to do with fucking EBITDA. EBITDA is important. You've got to understand what that means. But seller psychology can massively change the value of a business. On the other side, you have somebody that's the same business, but he's having so much fun. He doesn't really want to sell. Every business is for sale. It's just a question of price and terms, right? If he's got a really low MUD score, he might want a 5x multiple. He doesn't give a fuck what DealStats says. DealStats says my business is worth 2.5. I don't care. If you want to buy it, you're going to have to pay me 5x. And I want 80% of the cash at close. I don't care about anything else. So motivation, urgency, distress is a really important thing to understand in the context of valuation. Now, deal structure. Remember I said at the start that the more you pay at close for a deal, the cheaper it's going to be? I said that once on a podcast. And the person who was interviewing me said, wouldn't it be amazing, like, if you could, like, build a model around that? I said, well, they can, right? So I took over 100 of my own deals that I closed over a 10 to 15 year period. And I took hundreds of my students' deals. Every time they close a deal, they send me all their details. And I can look through and see what was the valuation, what did they pay, how much was closing, how much was seller financing. And I built a model, right? And what the model told me is that if the 100% valuation was where you've got nothing at the closing table, it's a 100% seller financing deal, then if you were doing the opposite type of deal, which would be, say, an SBA 7A loan, we'll get into financing in a minute, where you're putting 90% down at the closing table and only 10% as a seller note, you'll pay, the model calculated, about 57% of the total valuation. So let's say a business owner said, yep, I'll take $10 million over 10 years for this deal, be $1 million a year. Statistically, he's going to accept $5.7 million for that business today if he's going to get 90% of that cash at close. So I didn't just make these numbers up. We looked at hundreds and hundreds and hundreds of deals that not only I'd done, but all of my protege students done as well. So let's pull all this together and let's expand on this example. So exactly what I showed you before, $2 million of revenues, $300,000 of EBITDA, 50% margin. We took the 3-year average, the numbers are going up. So the average was $355,000 of adjusted EBITDA. And then we pull up DealStats. DealStats tells us that the average margin in professional services is around 22%. We're at 22.5%, so we're in line. But what does that tell you? It tells you that it's an average business, doesn't it? So when we look at the transfer of value scores, we'll be able to see how average this business is. If its margins are average, then the transfer of value scores are probably going to be average as well, right? And if we get a look on DealStats, a deal like this is probably worth around a 3.6x multiple. So 3.6x multiple of 355,000, multiples higher than the previous example. It's just under $1.3 million of enterprise value. No real estate. We have the surplus cash. We deduct the liabilities that we're going to inherit as part of the deal structure. So now this business is worth not $1 million, but $1.213 million. So that's the financial valuation. Now, let's look at working capital. Let's look at liquidation value. We know the liquidation value is $400,000. Let's look at the transfer of value. So let's say it was 5 out of 6 for customer, lots of recurring revenue, lots of customers, 4 out of 6 on employees, above average, structural, below average, not a lot of KPIs, systems, processes. You can fix all that, by the way, through a handover period when you buy a business. And then below average on social. Not a lot of great reviews, but kind of an okay business. So scored 62.5% on that transfer of value scale for Goodwill. Let's plot it on the chart. Just bang in the middle, right? So we're only going to pay the market multiple for this deal. It's not a weak business, so it's worth more than liquidation value, but it's certainly not a best-in-class deal. So if the broker or the seller wants a multiple that's higher than the market average, you show them this chart. Sorry, your business isn't worth that. That will then tell you that their MUD score is not high enough. And then we can calculate, because we know what the goodwill is. The goodwill is the valuation, 1.213 million, less the $400,000 of liquidation value. We know the goodwill's $800,000 and change. We can then, through that score, assign where that value lies. So a third of that goodwill lies with the customer. So you know you've got a business with a great customer base, phenomenal. You need to work a bit on the employees, structural, the social stuff as well. Okay, so financing. Here's the deal financing stack. So we valued the business. We know exactly how much it's worth. We'll talk about deal structures as part of financing. We've looked at transfer of value. We understand seller psychology. There are three things that make up the valuation of a business. The liabilities, just gone through that. And then in most deals, but not all, you make a closing payment. And then every single business you ever buy needs to have seller financing. Don't ever, 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 that's 5 evers, buy a business and put 100% cash down the closing table. Doesn't matter how cheap the business is. Because what happens is when the seller gets that money, it's a big psychological shift. Ordinarily, when you buy a business, they'll give you a 90-day handover period. Sometimes more, sometimes a bit less. If you're paying them all the money, they're going to fuck off. They're not going to help you, right? They're not going to help you. They've got no incentive to stay behind and help you integrate and get that business to continue to be successful, right? So don't ever, ever, ever pay 100% to close. You've got to hold some money back because you'll have completion accounts. There'll be things that need tidying up. They need to hand the business over to you professionally. They need to take around all the customers. You need to do all of that stuff, right? If you pay them all the money at close, chances they're not going to do that. It's happened to me 3-4 times. It hurts, right? It's tough. So there's 8 ways you can finance a deal. The first 2, you'll love this, are existing business resources. Surplus cash, we talked about that in the deal example. There was $135,000 of surplus cash in the business. We're having some of that. That's going to be part of the financing stack. And then often businesses have existing lines of credit. So when you're doing your due diligence on the business, they might have a big line of credit from the bank that they haven't used. Boom. I'm drawing down on that bad boy. That's going down on my closing payment. It's the quickest debt you'll ever get into a deal. So 1 and 2 are the existing business resources. And then 3 and 4 are serviced by the future business cash flow. So we've not gone anywhere near a financial at this point, right? Number 3 is seller financing. So it's taking the cash flow that the business is generating and it's giving some of that to the seller over a period of time, right? That's called seller financing. Or in England, we call that deferred consideration. And then you also have something called earnouts. So earnouts are like bonus payments. And what earnouts do is if the business really grows and the cash flow really grows, you can share some of that additional cash flow with the seller. That's called an earnout. So an earnout is only contingent on like future higher financial performance. And earnouts are really useful if you have like a value gap. On this deal, I said, hey, it's $1 million. And the guy's like, no, I want 2 million. Because this thing's going to grow, the market's going to take off, I've got all these potential contracts in the wings. That's great. But you can only buy a business on its current valuation. You can only look back. What's happened to date, right? The future, no one can predict. So you can't buy a business of future potential, but if you're in a negotiation and you can't bridge that gap, an earnout is a great example of that, right? It's a great example. So earnouts can be used to pad the deal. And then the other 4 are what we called OPM, other people's money. This can be debt, where a bank's going to lend the business money and the business is going to pay back with interest. Or it can be equity, where an investing partner, like a private equity firm, an angel investor, a family office, they're actually going to buy a percentage of your deal, right? And then they're your partners, right? And that can be really useful for you if they've got a skill set that you don't have, or they've got market relationships that you don't have. Really, when you're going for an investor, you want an investor that's going to add value to the business. Really, really important. So number 5, asset-based lending. So all those things that we talked about on the balance sheet, banks will lend money against those. Accounts receivables, we'll go through a lot of examples of these. Accounts receivables, you can lend against those. Inventory, intellectual property, real estate, and then equipment that sits inside of the business. Banks will lend you money on all of those different things. Then you've got something called cash flow lending. And this is where the debt market is really moving to in this country, and has been kind of since before COVID, right? Because you've got something called the SBA, the Small Business Administration. And it's a phenomenal thing. It's basically Uncle Joe Biden saying to all the banks all across the country and the family offices and the debt funds, guys, if you put money into acquisitions, the federal government will guarantee 75% of the loans, right? So we're all putting our money in banks and getting, what, 0.5%? Your bank is taking your money, they're lending it on a deal at 9%, and the federal government's guaranteeing 75% of the money. It's Christmas morning if you're a bank, right? Because if the business fails, they cash in the federal insurance policy, and then they've still got the lien on the business to get the other 25%. It's absolutely unbelievable. So all the banks now are trying to push you all down the 7A route. You've also got the 504 loan if you've got real estate, and then for smaller deals, you've got the express loans, and you've also got big debt funds for like big boy pants deals, and those things as well. And then you've got other forms of capital, right? So people use their 401ks. I've done deals where I couldn't get any other funding anywhere else. I called the top 5 customers in the business, and they funded it, because my business I was buying was so strategically important to them as a supplier. I've also gone to some of my biggest suppliers when I've done a deal and said, hey, I need some money to buy this business so I can keep serving you. And otherwise I'm going to just go to the next supplier that gives me the capital. They're going to give you the capital, right? And then you've got hard money loans. So sometimes you might find a deal and you can get it on like the craziest, lowest terms, but the seller's so distressed, the mud course is so high, they need a quick closing payment. And if you don't want to go through the process of like working with the banks, which can take, in some cases, a few months, you can get a quick hard money loan, which is a very expensive interest rate, like a bridging loan, make the closing payment, and then as the owner of the business, then you can do a refi. You can refinance it like you would do in the real estate world. So those are the 8 financing strategies. So let's look at a couple of options on our deal, right? So remember, $2 million of revenues, $450,000 was the current year's adjusted EBITDA. Now, let's look at a 10-year annuity. I'm going to show you exactly how to do an annuity deal after lunch. I'm going to go through it in a lot of detail and around the psychology of it. But for now, just know this. If we're paying for a business over 10 years, we're paying nothing at closing, we're going to pay more money for it, right? So in my opinion, that's going to be about 2.25 million. And you're thinking, Carl, you are crazy. You just told us this business is worth 1.2. You've just told us it was an average business. You've just told us that it had average seller psychology. Why the fuck are you adding $1 million to the valuation? Because I'm paying for it over 10 years. I don't care, right? It's doing $450,000 today. I'm giving half of that money to the seller, and I'm keeping half of that money to myself. I'm getting $225,000 a year of free money. What do I care if I'm overpaying for the business? It doesn't matter, right? You have to do that so the seller will take the risk of doing that deal. We'll get into that in a lot of detail this afternoon. Now, the key metric that you need to look at every time you structure a deal, this is the most important number you will ever calculate as a deal maker, and it's called the debt service cover ratio, DSCR. If you've done real estate deals, you know exactly what I'm talking about. And the debt service cover ratio is how much cash flow does the business make today divided by how much is it going to cost me to service that deal. And you want an absolute minimum of 1.5. If you go to the bank, they look for 1.25. I like a little bit more headroom, right? So 1.5 is the minimum. In this example, I've got a 2x debt service cover ratio. So half of the money's coming to me, half of the money's going to the seller. I'll do that deal all day long, right? Even though I'm overpaying for the business by almost double, $1 million premium, right? So that would be option one, it'd be a 10-year annuity deal. Option two, the seller might come back and say, well, actually, I like the fact that you pay me more money, Carl, it's very generous of you, but I'd like to get my money out within 5 years, not 10. I don't want to wait 10 years. I want to get my money out in 5 years. Okay, so again, he's getting the money over a short period of time, so the valuation's going to go down, right? So in this example, it might be $1.4, $1.5 million. It's still a premium because he's still getting the money over 5 years, but it's not as big of a premium over 10 years. So in this example, to hit the 1.5 debt service cover ratio, I'm probably going to be paying 2/3 of that cash flow to the seller, right? So it's making $450 today. I'm going to pay 65% of that, call that just under $300,000. I'm still getting the rest. And over 5 years, 292,500 multiplied by 5, it's just under $1.5 million. Divide the 450 by the $292,500, I've got a debt service cover ratio of 1.54. I will do that deal all day long. It's amazing. Option three, let's look at an SBA loan. Now, for the SBA loan, the seller's getting 90% of the money at close. So you could argue, we're going to lower the valuation, right? We're going to take the valuation a bit lower, but let's assume we're going to do it on the 1.213. So a typical SBA loan, there's loads of different variables in now, but the standard kind of way is the buyer or the buyer's investor partner puts down 10%. The SBA pays the 80% loan over 10 years at about 9%. And then the seller takes a 10%. It's called a standby seller note, which they get sometime in the future. So in this example, you or your investor partner would put down $121,000 change. The SBA would kick in for the bulk of it, just under $1 million. And at 9%, that amortizes at about $147,000 per year. So that's your total debt service. You divide that into your current adjusted EBITDA. You get a debt service cover ratio of 3.11. So that's actually the best deal in terms of DSCR, because what are you doing? You're paying for the business over 10 years, but you're paying a market or even lower valuation. When you're doing an annuity deal, you're paying an inflated valuation over the same 10-year period, so it's going to be a lot more cash hungry to actually do that deal. And then option four, you might want to do a traditional deal where it's like, hey, I don't want to go down the SBA. The seller doesn't want an annuity type deal. I've got to look at the balance sheet. I've got to do a traditional leverage buyout or an asset-based lend, an ABL. So we've got $135,000 of surplus cash. Thank you very much. I'm having that. Now remember, the business had $350,000 of fixed assets. It could be equipment, it could be whatever, right? Trucks. And normally, you can get about 50% loan to value. So if there's $350,000 of fixed assets, I'm probably going to get about $175,000 in cash by leveraging that. Accounts receivables, the percentage is a lot higher. So it's typically 80%, depending on who the customers are. So if there's $365,000 of AR, I'm probably going to get around $290,000 of cash. So if I add the surplus cash, the fixed asset financing, the AR financing, I've just raised $600,000 on my deal. I'm probably going to pay $1.4 million to buy it because it's just under half at close, just under half in the future. So I'm paying $600,000 at close, and then I'm probably going to pay $800,000 as a seller note. So that's a total valuation of $1.4 million. And then let's say we're going to pay all that back over 6 years at, say, 10%. That's a $233,000 a year debt service. So my DSCR is 450 divided by 233 is 1.93. So we've got 4 deal structures, right, for this business. So which is the best deal? Well, it depends, right? Depends on what your outcomes are in terms of the deal. So offer one is a 10-year annuity. It's the highest valuation. That's not great. There's no closing payment. It's got a debt service cover ratio of 2, and you're going to walk into $225,000 a year in cash flow, right? And you can do that. You can do that deal in an hour, but let's say 2 weeks, right? Who'd do that deal? Who likes cash flow? Who wants free cash flow, right? You'd do that deal all day long. Of course you would. You'd even do deal number 2. The valuation's lower, but the debt service cover ratio is lower, 1.54, because you're paying for the deal over a shorter space of time. But you're still walking into $157,500. So if I was the seller and Cindy said to me, hey, Carl, 10-year annuity, you get 225, I get 225. And I said, no, Cindy, I want my money in 5 years. You're only going to make 157,500. Cindy's probably not going to say no. She's going to say, let's do that deal, because she's walking into that cash flow on day one, right? The two advantages, the big advantage over an annuity deal is they're quick. This afternoon, I'm going to show you exactly how to do one of these deals, right? But they're very, very quick deals. Versus if you go to the SBA is by far and away the best deal, right? It's the lowest valuation. It's the highest debt service cover ratio. It's the lowest debt service, and it gives you the maximum amount of cash flow. Who likes cash flow, right? The more cash flow, the better, right? So the SBA 7A loan is by far the best deal structure. It's the best deal structure for the seller as well, because they're getting all the cash at close, and you're making more money as you own that business. But the one problem, because you're dealing with the federal government, it takes 16 weeks, right? It takes a while. And you need to have a 670 minimum FICO score, right? And there's a lot of kind of loopholes and different things you've got to jump through. But they're phenomenal deals if you qualify for SBA. And then an asset-based lend, which is the last one, median valuation, kind of a nice deal that actually. That's probably the deal I would probably try and do on this, because you've got about half the deal at close, half the deal in the future, so both buyer and seller are sharing the risk. You typically get that deal done in 4 to 6 weeks. You're still walking away with $217,000 of cash flow. So that's how you value businesses, that's how you structure deals, and that's how you finance them. So who loves numbers? And numbers love me. Thank you.